Hello everyone, welcome to chapter 4. What is a share? We are going to learn 5 different lesson objectives. The first lesson objective is what is a share, and the second objective is what is shares outstanding. The third is comparing terminology between a whole business and ownership of just one share. The fourth is basic valuation technique for one share. And the fifth is why is stock investing so attractive? So without further ado, let's get started. If you're just joining us with this chapter, please note that there are two other chapters before this chapter. In previous chapter 3, where we were talking about an owner named John who had a coffee shop, we were really trying to understand how he values that business, that small business. In this lesson, what we are trying to do is something a little bit different. We are still going to use John in our coffee shop to teach the concept of breaking a company down into shares. So, in the previous chapter, John was trying to sell his business for 200,000. So, let's say he's having hard time selling his business for 200,000. And now he is wanting to sell it for 100,000. So, that coffee shop that you see right there on the screen, he's trying to sell that business, that small business, for $100,000. And he's really having a lot of problem doing that. And so maybe he's going to break the company down into shares. Okay. So what is a share of stock? As you can see, I took the picture of the coffee shop, which was a whole business, which he was valuing at 100,000, and he was trying to sell it with no luck, no buyers. And what he did is he divided this company into what we are going to say is 10,000 pieces. So as you see the little squares, these squares represent that. He split that business up into 10,000 different pieces. One piece of that business, which you can see the little square there, equals $10. The way I came up with that evaluation there is we simply took the $100,000 and decided to split the business up into 10,000 shares, and therefore if you take a 100,000 and divided by 10,000, that's $10 per share. The thing to really take away here is the term shares outstanding. That's the correct terminology. Whenever you would be buying stocks, when you see that, that's how many pieces the company has been divided up into. So if you start with a whole business and you just look at the shares outstanding, and that's how many pieces of that business it has been split up into. So if you look at a company like Bank of America, probably close to 8 billion shares outstanding. So that's how many pieces Bank of America is broken up into. And if you own one share, well, then you own one part in a 8 billion equal parts of the company. So let's compare the terminology between a whole business and one share. As you learned in chapter 2 and 3, and if you have not seen those chapters, I would recommend that you go back and watch those. That is so that this is a little bit easier for you to understand. So we see the whole business there in the market price. That terminology, market price, is what John is asking for the business. He wants $100,000 for the business, as we learned in chapter 2 about the income statement. I mean, there is those three documents: the income statement, balance sheet, and the cash flow statement are the three documents that a business has that represents its value. If you can read those three documents, then you can understand what it's worth. So on the income statement, the bottom line on the income statement on that physical document is the net income. So we found out that for John's business, his net income was $20,000. That represents his profit. So in 1 year, he has made $20,000 on his business. The balance sheet represents the equity So if John would end his business, if he would kill his business today, fire his employees, and he would sell everything that he has and pay off the debts, what would be left is $10,000. And we determined that's the equity. We also talked about how the margin of safety is the difference between the equity and the market price. So let's say you would buy this business for $100,000 and the next day you would have to kill the business because it's not making any money. Well, the only thing you would get out of the business is $10,000. So your margin of safety there is very little now. If the business continues to run and is alive, you can expect to make 20,000 in a year. So that's the terminology there. And if you want a further explanation, like I said, please go back to lesson 2 and 3 to really fully understand that. So when we look at the whole business, all those numbers pretty much make sense. And I'm skipping the cash flow statement here because that's something that will be taught later in the coming chapters. Now, as we look at the one share of the business, which we have determined and has been broken down into 10,000 pieces from that whole business that you see over there, let's take a look at how the terminology changes as we look at the one share. Okay, so here we are. You can see on the screen that we have one share and then we have total number of shares outstanding 10, which is 10,000. So we know our market price is $10 a share because we just took $100,000 and divided it by 10,000, which is outstanding shares. The best way really to understand stock investing is to look at one share like it's a miniature business. This might sound crazy, but think of maybe like a little miniature people working in that little miniature coffee shop, and instead of it producing $100,000, it's only producing $10 or it's worth $10 because it's really a small and a tiny, that might be a silly way to look at it, but for some people that really starts making sense. So let's assume that this little small business market price is $10 a share. So the earnings for the business, which is the same thing as net income, it's the exact same number, but the only difference is it is called the net income when you are valuing the whole business and earnings when you are only valuing one share. It represents the exact same thing but only for one share. So if you look there, if you take the $20,000 in net income and you divide by the 10,000 shares outstanding, you would be left with $2, the EPS. That earnings we see there, it says earnings in EPS. EPS stands for earnings per share. So for one share, the earning is $2. Then for the balance sheet, we saw over there on the left for the whole business, it was $10,000 for the equity. And when you go to a per share basis on the right, that is not called equity anymore. It's called book value. We take $10,000 and divide it by 10,000 shares outstanding, which will give $1 of book value. So you know now that when a person says book value is $1, they are talking per share as opposed to the entire business. But what you are going to find is it really does not matter if you are talking the whole business or you are talking one share. It's all proportional because everything is being divided. Every single term on the left is being divided by shares outstanding, which is 10,000. So when we look at the book value for this one share, it's $1. So let's go to the next slide here and see where this takes us. So when we are trying to get into valuation of the business, we are going to value this one share the same exact way that we evaluate the entire business as a whole. We learned different valuation techniques in chapter 2 and chapter 3. And so I am going to teach something a little bit new here, which is price to earnings ratio. And this is everyone's favorite term, and it's all often referred to as PE, P by E of the business. So when you hear a person say PE, this is what they are talking about. And all you got to do is, it's fairly simple. Take the market price, which is P, as you can see, the P divided by the E, the market price divided by the EPS, which you know is the earnings per share. Okay. So John's business, if you had one share, we know that the market price is $10, and we take the $10 divided by the EPS, which is the earnings, and that's the profit. That's the bottom line profit in 1 year, which is $2. And you divide those numbers, in which you end up with is a ratio of 5. And there is no units on that. When you divide a dollar by dollar, you are going to have no units. So the ratio is a 5. That would be your PE. So what does that mean? That number 5 that we came up with. But what does that mean actually? Why is that number so important? The best way I can describe the PE ratio is to remember this phrase. If you read this phrase, for every star, you will replace the PE ratio in where the star is. Okay? So for every $5 I spend buying this stock, I should receive $1 in profit a year later. So that's a really powerful sentence to remember. If that's something you are taking notes, I would definitely write that down, because that sentence applies for any company. If you are talking about something on a New York Stock Exchange or any other country's stock exchange, right now you can apply that sentence to the PE ratio. So let's say that the PE ratio is 10 for a company. So I would say for every $10 I spend buying this stock, I should receive $1 in profit a year later. So as you can see, the higher that PE ratio is, the worse that sentence sounds. Because if I said for every $100 I spend buying the stock, I should receive $1 profit a year later, that doesn't sound nearly as good as for every $5 I spend buying that stock, I should receive $1 in a profit in a year later. So when you start talking PE ratios, you are obviously looking for something that's lower in number, because that's a lot better than something that's higher. And all you are doing to figure that out is you're taking the current market price of what the company is trading for, and you just divide it by the EPS. Okay. So when we look at the whole business versus one share, I want to show you how it does not matter if you are valuing the entire business or you are just valuing one share. When we look at that whole business, we know that the net income or the profit is $20,000 for the year, and the market price is $100,000. So if you had $100,000 to buy John's business and you bought it, and 1 year later you could expect to earn $20,000 on your net income. So your expected return in 1 year would be 20%, because 20 divided by 100 is 20%. Now let's look at the numbers for the one share. So when we are looking at that little micro business, is how I want you guys to look at it. Okay, you would see that the earnings, and all I did was I took those numbers and I divided it by 10,000, because that was the number of shares outstanding. So that will represent the value of one share. You can see that the earnings is $2 and that the market price is $10. So my expected return in 1 year is the same thing. It's 20% again. So the point that I want you to take away from this slide is that regardless, a lot of people think that if they are buying one share, that's different than if they are going to buy the entire business, and that is just absolutely false. Every time you look at just one share, you need to look at it as if you are valuing the entire business, like you are going to buy the entire thing. So if you are talking about Apple share, if you buy one share of Apple, you might as well be buying the entire thing, because all the numbers are proportional. So that's something that you absolutely have to understand. And whenever I see people trading stock, these days traders, right? And it's kind of frustrating because they really don't understand what's actually happening here. That they are actually buying a business, they're absolutely and positively buying a business every time they buy one share. And that's something that is so fundamental to value investing. And this is what my fundamental purpose of this teaching is. So, why is stock investing so attractive? The best way I can explain this to people is kind of give them an example. We were just talking about John's coffee shop. So, as you look at that coffee shop, and I asked you, would you buy this business for $1 million? How would you answer that question? Most likely, you are going to laugh at me and be like, absolutely no, it's just crazy talk. You know, okay. So, as we established that, let's look at something else now. Okay, would you buy this business for $2 trillion? This business represents Bank of America. If you could buy the entire business of Bank of America, which is an enormous company all throughout the country, most of the people might have heard about Bank of America. They probably have checkings and savings account there. Would you buy that entire business for $2 trillion? Now, for a lot of people, that's going to be a lot harder question to answer because when it goes to 1 billion to 1 trillion to 2 trillion, these numbers just really don't make sense to most people. That's it. It's like asking an year old whether he know how much $10 million is, and he has no clue. That doesn't even make sense to him because that's not something that he's familiar with. Okay, in those two questions on the screen, what I did is I used the proportion. When I asked you if you would be willing to pay $1 million for John's coffee shop, basically what I did is I took 10 times the current market price, which is somewhat of a believable price, and I took 10 times that to ask you $1 million. And I did the exact same thing with the Bank of America. Right now, the current market price for, if you want to buy every single share of Bank of America, would be about $277 billion. So the 10 times that would be around $2 trillion. I just rounded it to 2 trillion actually. So the question that I initially asked you at the coffee shop was totally ridiculous. And the question that I asked you about the Bank of America was equally ridiculous because it was the same amount over the actual price. So I bring this up to highlight the difference that most people have once you start getting past the $1 million or the $10 million mark. Most people have no clue what the value of something is. It does not even make sense to them, and so it further gets complicated when you take a large business like this and then you chop it up into millions and billions of shares and you're saying all that company price is $30 a share. That means nothing to people. They just don't understand it. And so if you value one share of the business like you are going to value the whole business, you are going to find that you are going to have much more success when you get involved in the stock market. So the thing that I really want you to understand here is, if you look at the coffee shop, if a person was going to buy that coffee shop, they are going to do the calculations. They are going to do the hard math, and they are typically going to purchase something like that based off of numbers that they have calculated and understood. But what you find in the stock market is just opposite. You have a lot of people who don't know what they are doing. Let me clarify again. There is a lot of people who do know what they are doing in the stock market, but there are a lot of people who really don't know what they are doing. They trade on the motion opposed to the numbers or the math work because they never fully understand what's actually happening with the numbers, and they have no idea what the value of a company of that size actually is. So the thing that to really understand here, the reason that the stocks are so attractive is because there is a lot of people that are trading on emotion. They are saying Oh, well, I have a Bank of America savings account, checkings account, and it's really good. I really like it. So I'm going to buy shares of that company. And that's their investment approach philosophy, which unfortunately kind of scary. And also they think that they can be successful, but in reality they might be paying 10 times the value of the company, and they have no idea, absolutely no idea. Reason that stock investing is so attractive is that there are so many traders out there that are moving these market prices not day to day but throughout the years. What you will see is that some of these prices sometimes are offered to you to buy a company like Bank of America at a really cheap price. If you go back in the year 2008 2009 time frame, some of the prices that you could buy companies for that literally had no depth. We are totally insane. It didn't even make sense how people could be trading them as low as they were. And last year in 2022, the prices were more expensive and the prices are rising. So you are not going to be able to get as good as of a deal on some of the companies. So, your job is to always calculate the intrinsic value of the business, regardless of how big it is, and then compare that value to the price that it's trading for. And hopefully, you will get a good deal. When I am recording this video in 2023, I see that the prices have went down a lot, and I hope you could do the math to find if they have reached the intrinsic value or not. Or maybe you have to wait more till it goes down. So, this pretty much summarizes this chapter's objective. I just want to highlight that the next video session I have a practical exercise where I take you through a real company on the internet and show them all the terminology that we have been learning through the last 4 chapters. So, if you want to know where you can find the book value, or you want to find where you can see what the earnings per share EPS, I have a practical exercise and I am going to take you through and show you where all these numbers are so it start making sense for you. In this chapter 4, we learned 5 main objectives. We first figured out what is a share, then we learned what the term shares outstanding is, and then we compared the terminology between a whole business and one share. And then we learned the basic valuation technique for one share with the price to earnings ratio. And then finally, we learned why stock investing is so attractive. So, this concludes our chapter 4. Be sure to check out the practical exercise which is coming if you want to see where some of the terminology is, and we will see in the next chapter. Thank you all.